Effective working capital management requires organizations to understand how cash moves through the business. Two important measures used to assess operational efficiency and liquidity management are the operating cycle and the cash flow cycle, often referred to as the cash conversion cycle. These measures help management evaluate how long it takes for resources invested in operations to be converted back into cash. By analyzing inventory holding periods, customer collection periods, and supplier payment periods, organizations can identify opportunities to improve liquidity and reduce financing requirements. Understanding these cycles is therefore essential for management accountants involved in working capital planning and performance analysis. The operating cycle measures the total time taken for a business to purchase inventory, sell goods or services, and collect cash from customers. It represents the period between acquiring inventory and receiving payment from customers. The operating cycle consists of two key components: inventory days and trade receivable days. Inventory days measure how long inventory is held before being sold, while trade receivable days measure the average time customers take to settle outstanding invoices. Together, these measures indicate how efficiently a business converts inventory investments into cash receipts and provide insight into operational effectiveness. Inventory days, sometimes called inventory holding days, represent the average number of days inventory remains in the business before being sold. The calculation is typically expressed as inventory days equals average inventory divided by cost of sales times 365. A lower inventory days figure generally indicates efficient inventory management and faster stock turnover. Conversely, high inventory days may suggest slow-moving stock, excessive inventory investment, or potential obsolescence risks. However, the optimal level depends on the nature of the business and industry. Effective inventory management contributes to improved liquidity by reducing the amount of cash tied up in inventory and accelerating the conversion of resources into sales revenue. Trade receivable days measure the average period customers take to pay amounts owed following a sale. The calculation is generally trade receivable days equals average trade receivables divided by credit sales revenue times 365. This ratio provides insight into the effectiveness of credit control and collection procedures. Lower receivable days indicate faster cash collection and stronger liquidity management, while higher receivable days may suggest collection difficulties or generous credit terms. Because receivables represent funds not yet received, reducing collection periods improves cash flow and decreases the need for external financing. Together with inventory days, trade receivable days determine the length of the operating cycle. The cash flow cycle, or cash conversion cycle, extends the operating cycle concept by incorporating trade payable days. Trade payable days measure the average period the business takes to pay suppliers and are calculated as trade payable days equals average trade payables divided by credit purchases or cost of sales times 365. The cash flow cycle is calculated as cash flow cycle equals inventory days plus trade receivable days, trade payable days. This measure reflects the net period for which cash is tied up in working capital. A shorter cash flow cycle indicates greater efficiency because cash invested in operations is recovered more quickly. Trade payable days play an important role in working capital management because supplier credit effectively provides short-term financing. Longer payable periods reduce the need for external funding by allowing businesses to retain cash for longer. However, excessive delays in payment may damage supplier relationships and result in penalties or loss of favorable trade terms. Consequently, businesses must balance liquidity benefits with maintaining strong commercial relationships. Management should seek to optimize payable periods without jeopardizing supply chain stability or supplier confidence. In summary, the operating cycle and cash flow cycle are key indicators of working capital efficiency and liquidity management. The operating cycle measures the time required to convert inventory into cash through sales and collections, while the cash flow cycle adjusts for supplier credit by incorporating trade payable days. Inventory days, trade receivable days, and trade payable days are therefore fundamental components of these calculations. By monitoring and managing these measures effectively, organizations can improve cash flow, reduce financing costs, strengthen liquidity, and enhance overall financial performance. Consequently, these cycles remain essential tools for management accountants and business decision-makers.